Welcome back to Morning Markets on Thursday the 26th of May. We had a bounce back in stock markets yesterday, led by the US and the consumer discretionary and technology sectors. Bond markets were relatively calmer. There was very little movement across the yield curve on the day. Two areas to discuss this morning, one being rising pressure on Chinese government to ease COVID-19 activity restrictions. And we'll also do a quick review of the minutes from the latest Federal Reserve Open Market Committee, so the central bank minutes from their meeting earlier this month. The component linking the two really being supply chain efficiency and the potential for lower restrictions to moderate global input prices. We've been discussing the challenges for some time around global supply chains, and a lot of this is driven by China and their decision to enact a zero COVID-19 policy, which essentially requires cities to enter a strict lockdown if only a handful of cases are reported. At present, there are more than 60 million people in China living under a lockdown of some form. In cities with infection cases, domestic travel is halted. Schools and businesses are required to close until local authorities confirm that they have zero cases reported. China went down the route of developing their own vaccinations to tackle the virus. However, the effectiveness against Omicron is viewed to have limited ability relative to some of the versions which we have here in the developed world. Also, take-up in the vaccine has been relatively low in comparison. At this point in time, only around 60% of citizens over the age of 60 are fully vaccinated at this point in time. These restrictions in China are limiting the ability for citizens to go to work, but also to go out and spend, which is having an impact on China's economic growth. Yesterday, these concerns were addressed by China's Premier of State Council on a video conference to Chinese officials, where he stressed the importance of restrictions being relaxed to help companies resume production, but also supporting China in meeting their economic growth target. Their economic growth target is currently 5.5% on an annual basis. The most recent print highlighted in the first quarter on an annualized basis, economic growth was 4.8%, so they've fallen behind that target. We've seen a couple of examples of ways in which China and the government are working in order to support demand and economic growth overall. We've seen a reduction in mortgage costs across a number of levels, but we also had the unveiling of a $21 billion 33-point plan, which was unveiled earlier this week, which has a number of factors. It's got more immediate term factors such as tax rebates, also emergency loans to airlines, but also longer term in terms of investing in infrastructure, areas such as rail lines, which will have a longer term fiscal impact, but will also be supportive in improving global supply chain efficiency. We've also seen signs of certain cities such as Shanghai start to ease their restrictions, but to support global supply chains, we really do need an acceleration within this. Chinese stock markets performed positively on the back of this stimulative measure, but also the pressure on governments to ease restrictions. Last night, we also received the minutes from the Federal Open Market Committee and their meeting, which took place earlier this month. The key takeaways were, whilst there's a divergence between the members in terms of the number of hikes and the size of the hikes in terms of interest rates, which they believe need to come through between now and the end of the year, there is a consensus view that the central bank does need to get to work in terms of raising rates. At this point in time, they are expecting to see interest rates settle at around 2.5 to 2.75 by the end of this year, potentially January of next year, which is what they're considering to be the neutral rate. However, Chairman Jay Powell made clear earlier this week that they're going to keep tightening until they've got clear and conviction signs that inflation is slowing and moving back towards that 2% target. In other words, they're going to keep tightening until they get the signs that inflation is contained. And in that, within the minutes, Jay Powell didn't rule out the potential to tighten further beyond that 2.5, 2.75 level. They've got a careful balancing act in terms of managing economic growth and containing inflation, but we'll continue to keep you up to date on this topic here on Morning Markets. Thank you very much for watching here this morning.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.